Well, good morning, everybody. I want to welcome you to today's top 10 stock pick sneak preview. You got John Hopkins here. Tom Bowley going to jump in just a minute. Want to welcome anybody new to Earnings Beats. Great to have you joining us this morning. Certainly want to welcome our existing subscribers. Many of you have been with us for a long time. It's really very satisfying. You've been instrumental in our success in helping us to grow the service and add features. We've added a lot of features this year. I'm sure a lot of you have noticed. A lot of new chart lists, just tremendous amount of information that Tom Bowley is providing each and every day. I'll remind everybody that today's event will be recorded. If for some reason you're unable to stick around, no problem at all. Aaron will make sure everybody gets a copy of the recording. You can look at it at your leisure. We have a couple of events coming up that are member only next week. One is the Options Max Pain. That's always a great one. I love going to that one. That's when Tom takes a look at the overall market, does an analysis of the major indexes, and even some individual stocks that have heavy short or long puts, calls, interest that could make significant moves into Friday's options expiration. And we've had some tremendous winners recently, just nailed a bunch of them. So that is really a one that I think everybody should attend. And then next Thursday, as a follow-up to today's session, will be the actual top 10 stock picks, where Tom unveils 40 stocks in all, 4 different portfolios. He'll be going over those in a minute. And that'll be on the 18th, which is Thursday. So both of those events next week are members only, whereas the one this morning is open to the public to give everybody a chance to learn a little bit more about Earnings Beats. One other thing I want to say, it's that time of the year. We have our fall special. And if you're just tuning in for the first time, you're on a trial, you definitely want to think about taking advantage of that. If I can have Aaron share that screen. Okay, here you go. If you go to our homepage, the public homepage, you'll see the fall special. All you have to do is click on that link, and it will show you the deals. And right now, really, there's nothing, this is the best deal that we offer. And just very quickly, before I get into this, all of our annual members should have gotten an email yesterday. If you didn't get an email, just shoot us an email at support@earningsbeats.com and we'll make sure you get it. But basically extending an offer to our current subscribers that gave you an option to sign up for the 1, 2, or 3 years extension. And remembering, if you're already paid up to a certain date, that time will be added as well. So you're not going to lose any time. You're just going to save a lot of money over time. And for anybody new to Earnings Beats, just so you know, our monthly fee for membership is $147. Now that includes everything we have to offer in our regular service, stock service, and our ETF service for those people who like to look at ETFs. And we've had some great success this quarter with the ETF compared to the S&P. So to give you some context, $147 is our monthly membership. And so if you did that for 12 months, that'd be $1,764. When you sign up for an annual membership, it's $997. And you can see the fall special gives you 2 months bonus. So basically your average monthly fee is $71. You're cutting cutting it in half. And if you go for 2 years, you get 6 months bonus, and 3 years, you get a year bonus. Okay, so this is the time to do it. If you're thinking of committing, you want to be part of us. And for people who are new on a trial, you're thinking about us, we've found that number one, the vast majority of our members are annual. And the annual membership gives you a full year to work with us. You get 4 quarters, you get all the webinars, tons of webinars, daily market report, everything that we offer. So take advantage of the fall special, and I think you're going to be pleased. Okay, I know Tom's got a lot to cover this morning, so let's, number one, make sure he's ready to roll. How's it going, Tom?
It is going well. How are you doing, John?
Good. I'll tell you, when I saw this fall special come out, I signed up myself.
Good. I hope you signed up for 3 years.
I think I have a lifetime membership. Anyways, it's been pretty remarkable market, and I know you're going to go over the portfolios and talk about what you're going to be covering around the draft, etc. And if we have any time at the end, we'll answer questions. But I'm going to go ahead and turn it over to you.
Great. Sounds good. I want to welcome everybody, as John did. Appreciate you tuning in to this event. I know it's a Saturday. Everything's being recorded. So if you do need to leave at some point, don't worry, we got you covered. We'll get the recording out to everybody, and you can check it out at your leisure. This is going to be pretty interesting. Some of this is going to be repetitive to some of our members. Hopefully there'll be some new stuff in here as well. Obviously the themes of the market now and the way we're going to select the portfolios next Thursday evening is different than last quarter because market changes and we have new leadership and so forth. So we're going to go through all of that. But I want to go show you a little bit of history as well. So we're going to get in. Essentially, I'm just going to talk a little bit about why, in my opinion, our portfolios perform as well as they do. We'll go through and kind of talk about the really big picture, because that's where I start, is from the big picture. And then we'll talk a little bit about the results we had this past quarter, and we're still having got another 4 or 5 days to go before we close out this quarter. And then we'll get into some themes that have emerged in quarter 4. Some are the same as we had in quarter 3, some are new. And then we'll get into some of the stocks that we'll be considering for our portfolios and just kind of walk you through how we do that. So this is a really good event, and it's actually outside of the top 10 stocks, the actual draft that we do, which will be again next Thursday evening. This is probably my second favorite webinar. I like doing this because I like to teach, and I just like to go through and describe our process and the things that we do in order to come up with our portfolios, which have absolutely crushed the S&P 500. And we'll talk about that in a little bit. So I'm going to start first with, in my opinion, why our portfolios work. So I'm going to go to a chart that I go to very often. Those of you who are with Earnings Beats, I'm sure have seen this before. Even those of you who maybe just follow me on my shows and blogs and so forth have probably seen it as well. But I'm going to give you a little bit different take on it. First of all, I think the most important thing to understand and to gain from this chart is that you have these massive secular, and secular meaning long-term, but you have these massive secular themes that take place, these bullish and bearish themes. And while you can go up or down any day, any week, any month, if you're in a secular bull market, those pullbacks almost always represent tremendous buying opportunities anytime the market's pulling back. And if you look back, I've got these blue directional arrows that mark periods of secular bull markets. This is a 100-year chart of the S&P 500. 1950s and 60s, very bullish. 80s and 90s, very bullish. And now I think the 2010s and 2020s are going to be bullish, or have been bullish, and I think will continue to be bullish. But that doesn't mean it's going to be a straight up ride. When you go back into the 50s and 60s, if you study history, you'll realize we went through 4 recessions during this 20-year secular bull market. So you have cyclical or short-term bear markets within longer-term bull markets. And that's going to be really critical as we approach 2022, because I'm starting to get a little bit nervous about next year. And I'll talk a lot about that when we have our Market Vision 2022 event, which will be at the beginning of January. We'll start getting more information out about that soon. But going into these last 2 years, I've been very bullish, and I'm still bullish long term. I'm beginning to see some signs that next year we could have a rough patch. I think the volatility is going to increase tremendously over what we've been seeing recently. Anyway, that's a story for another day. But what I'm looking at, though, overall is that the market is in a secular bull market. And what that means, I'm going to show you what that means. I'm going to pull this down for just a second. And I want to show you just an image of an Excel spreadsheet that I've done. So just give you a little bit of history. So April 10th of 2013, that's when, in my opinion, the current secular bull market was confirmed. That's when we took out that double top on the S&P 500 from 2000 and 2007. So what I've done is I've calculated, this is all the sectors, XLK, which is technology, XLY, consumer discretionary, and so on, all 11 sectors, where they were on April 10th and where they were at yesterday's close. And then right here, this is the secular bull market return of all the sectors. And you'll see technology crushes everything. And so if you want to beat the S&P 500, you have to remember the technology group represents more than 24% of the S&P 500. So if your portfolio currently has stocks, technology stocks, and your weighting is less than 24%, and even worse yet, if you have some downtrending stocks, some of those technology stocks have been downtrending versus the S&P 500, I think you're doing your portfolio a disservice personally. Now, maybe it's a plan thing where you want to have more diversification and you want to be more heavily invested, say, in dividend paying stocks. That's fine. Just be aware that, that's a conscious decision that you're making, because historically, if you're not overweighted technology, the ability to outperform the S&P 500 dwindles quite a bit. All right. But there are other areas too. Look at consumer discretionary, up 323% since that April 10th, 2013 timeframe. Communication services, 317. Basically, it's in order, and you can kind of see this. Look down at the bottom. Over 8 years, I mean, everybody's all excited about energy right now. Energy goes through these stints where they're outperform for a period of time. The problem with energy over the last 8 years is that we've been in an environment of a rising dollar. And so energy and materials tend to struggle on a relative basis. Now, since that April 10th date, you can see S&P 500's down here, up 195%. So it's almost tripled. 1587 back on April 10th, closed yesterday at 4682. So it's been almost a tripling of the S&P 500. But look at the, this is a, what is it, sextupling of the technology area. 521% technology versus 194% on the S&P. And technology represents 24% of the S&P. So that 24%, the S&P is going to go right along with the XLK. It's the rest of, it's everything else that drags the S&P 500 down. Anyway, these returns are pretty interesting. And if you look at that S&P 500 return of 194 and you just kind of put it right here, materials underperforming, real estate, consumer staples, utilities, and energy. Those are your underperformers. You got industrials and financials kind of going along for the ride, maybe a little bit of outperformance, slightly more in healthcare, but it's really these three areas. And this is the three, what I call them, the aggressive groups. And this is where I want to be looking for some of the better stocks. Communication services, consumer discretionary, and technology crush the S&P 500 during secular bull markets. Now, you might look at this and say, well, yeah, but over the last 8 years, this is just something different. This doesn't usually happen. NASDAQ over these 8 years, by the way, 381% higher, the S&P 194%, the Dow Jones 143%. So it's those NASDAQ stocks. That's the high growth when you're in an environment where the economy is growing and there is a major shift from asset classes. When you get into a secular bull market, money is rotating into equities. The US equity market is in favor during these periods. Think about buying stocks and just kind of going along with the tide. You know, that you're just rolling with the tide because the stock market is going higher. You're getting in and you're just riding it. But within the stock market, you have areas of strength and you have areas of weakness. Basically, it comes down to aggressive sectors lead during secular bull markets, defensive sectors lag, and materials and energy are somewhat dependent on the direction of the dollar. So when the dollar is going up, you have to be careful. I'd be very careful, these two groups. They're just more volatile. They'll go through periods where you can trade them, but I think, you know, holding on to them for 90 days in our portfolios makes it a little difficult to pick those stocks. And we've had not a lot of great success when we have put these two put stocks from these two sectors in our portfolios. But the other thing you have to think about, we have an income portfolio, which is designed to capture dividend income. Well, not too many of these technology stocks and not too many consumer discretionary stocks, they're growth themes. So you're really investing for growth, not for income. So it's harder to beat the S&P 500 when you're investing in sectors that pay dividends, more, you know, higher dividends. You get a lot of consumer staples companies that pay nice dividends. The problem is the consumer staple group has been underperforming the S&P 500. So if you put a portfolio together, even good, you know, strong performers, it's making it more difficult because you're in areas that typically see money outflows to other areas like technology. So anyway, I just wanted to walk you through that because that's a really big part of what we do when we put together our portfolios. I know that if we want to beat the S&P 500, we've got to be looking in particularly these three areas. Does that make it a little bit riskier when we go through periods of difficulty in the market? Absolutely. Absolutely. You're going to see more volatility. In a secular bull market that keeps going higher, I think you're going to do better more often than you're going to do worse than the overall market. But there are going to be periods. We just had one February to May when growth stocks were out of favor. When the inflation took off earlier this year, we had a horrible quarter, horrible. Now we battled back and some of our portfolios, I think our aggressive portfolio is broken out now to an all-time high again. But it was a rough patch for us back then. So this isn't foolproof. Don't think that, hey, you just get in, you just make all this money. And I also always want to mention, we're not registered investment advisors. I'm not providing advice. I'm providing education. That's what we do. That's what these portfolios are designed to do, to show you what can happen if you stick with leading stocks and leading industry groups within leading sectors. One last thing I want to point out about this Excel spreadsheet, and then we'll get back to charts and things. This is June 21st, 1982. This is March 24th, 2000. This 18 years was during that last secular bull market. And I just wanted to point out to you what happened during that last bull market that lasted 18 years. We are right now in our just starting our 9th year. So we're maybe in the 4th inning of this secular bull market, in my opinion. I think we're going to go until 2030. I think it's going to be this tide that continues to lift. We're not going up every year. We're not going to go up like we've been going up. We're not going to go up like we did since the pandemic bottom. But I believe we are going higher with pullbacks and maybe even a recession or two along the way. Trying to identify those is going to be really important. But looking back at this 18-year period, I want you to look at what the NASDAQ did versus the S&P 500. So the NASDAQ during these 18 years rose from 168 to 4,963. It gained 2,854%. The S&P 500 during the same period, 107 to 1527, went up 1,324%. Notice we've just about doubled on the NASDAQ. And notice what we're doing in this secular bull market. We're doubling. NASDAQ's doubling the S&P 500. This isn't anything new. when you're in a secular bull market, money rotates towards growth. We'll have pullbacks along the way, and then growth will lead again. So I just wanted to let you know that this isn't anything unusual. What we're seeing right now in the market, history tells us this is typical. When money rotates toward U.S. equities and away from other asset classes, when the S&P 500 is outperforming gold and outperforming other asset classes, the bond market and so forth, this is what happens in stocks, okay? So just keep this in mind. All right, so let me go back to the charts. Okay, so here was 2013 where we broke out. Here was 1982. Actually, I think I ended up doing the calculation from this low. I could have done it from this high. I could have done it from this breakout. But essentially, it's pretty close to 2 decades. And no matter which low you go, I think it's still going to come out pretty much the same in terms of NASDAQ performance relative to the S&P and why you want to continue to be thinking technology. I know you sit here, I think it's human nature. You say, oh my gosh, these tech stocks have run so much, they can't possibly go any higher. You know what? We'd have been saying the same thing back in 1990, right before one of the biggest runs in technology in history. So don't make that mistake. A lot of people make the mistake of saying, oh, we've gone up so much, we can't go any higher. That last secular bull market, the NASDAQ went up 2,854% during that, while the S&P went up 1,300%. Right now, during this bull market, we're looking at so far, 381%, but it'll continue to build over time. And the S&P 194%. If I'm right and the market does what I think it's going to do over the next 10 years, we're, and I've said already, the S&P is sitting at 4,600. I think at a minimum in 10 years, it's going to be 10 to 12,000. I think it could be 15 to 20,000 on the S&P 500. And you might say that's impossible. You're crazy, you're nuts, you're too much of a bull. Only thing I would say is just remember that in, the S&P 500 in 1982 right here was 107. By 1990, it was maybe 350. And we ended the period at 1,500. So this is kind of where we are right now. I think this is kind of where we were maybe back in about 90. We had just gone through the 1987 crash, which, by the way, the pandemic looks very similar on the charts, little blip on the radar now. But we've come out of that, and I see still a lot of green ahead, blue skies, but green in terms of profits going forward. So that's really big picture. And it's important to talk about this, especially for anybody who's new, because I'm not just saying I'm bullish all the time, but we have to recognize these long-term secular bull markets. Last September, I think it was September of 2020. So about 14 months ago, I was bearish. We went up, set a new high. I think it was right in, or maybe it was 2019. I think it might have been 2019. I don't know. One of those, we had a pullback for a couple of months, but literally right at the top, I wrote a very bearish article talking about, the fact that the volatility index, put call ratio, and some of the sentiment indicators were telling us we were at the top short term. And that's what I'm going to be looking for in 2022. Because I think right now there's still a lot of non-believers. And if we keep going up, get through 5,000 on the S&P 500, I think we're going to start to see more and more complacency. And then we'll have some other issues. But again, I'm going to save that. We're going to talk about that in a couple of months. All right, so let me keep moving here. And I want to talk now about Q3 results. So if you're, again, new to Earnings Beats, if you go to our homepage, you just sign up, or you just go into earningsbeats.com. This is where you'll come in. John talked about that fall special right there. But if you scroll down, we have a free newsletter that you can sign up for. Although anybody who's come into this event today and is not already a subscriber, we'll get you set up. You can unsubscribe at any time. There's no credit card required. It's completely free. I think you'll enjoy it and you'll learn more about what we do, but you can unsubscribe at any time. But next to it here is our portfolio performance. And so if you look at our portfolios, I mean, the model portfolio, which is our longest running portfolio, started back in the fourth quarter of 2018. Remember that we started it right in the middle of that trade war when we had a 20% cyclical bear market. We literally started it right before we went straight down. And I remember the model portfolio, I think within, I don't know, a month, we were down 11% in the portfolio. That's how we got off to a really, really nice start. But we obviously have rebounded quite a bit because now the model portfolio is up 233% since November 19th, 2018. And if you just parked your money in the S&P 500 over that same period, 74%. So we're up more than 3 times the S&P 500. This quarter, the model portfolio was down quite a bit versus the S&P, but it's battled back and it's now even. But look at the aggressive portfolio, 22% versus 6%. Strong AD, 15% this quarter versus 6%. I mean, we're not talking about beating by half percentage point. These portfolios are crushing the S&P 500. When you beat by that kind of a spread, it does amazing things to your portfolio and to your, you reaching your financial goals and so forth. But I'll just say again, it doesn't come without risk. There's obviously risk. These portfolios are designed by putting 10 equal weighted stocks, 10 equal weighted. So it's only 10. Some folks don't like that because it's only 10 stocks. You're essentially putting 10% into each of the 10 stocks that make up that portfolio. But the problem is the more and more stocks you add to your portfolio, the more you're going to start working toward the S&P 500. The more you diversify, the more you're going to move toward. You can't keep outperforming by more and more by adding more stocks. It's counterproductive. I'm not going to say it's impossible, but it's pretty unlikely. Unless you're really, I mean, you might get 50 stocks, but you might say, I'm going to put them all in software or semiconductors. And then, yeah, if that area does well, you're going to explode. But if that area comes down, you're going to get hit extremely hard. So these 10 equal weighted stocks, we make sure we put them in different industry groups. We don't even, we're not trying to get into software alone or semiconductors alone. We'll have representation in those areas quite likely. But, we're not going to fill our portfolios in one area of the market. But you can see those returns. I think they're pretty strong relative to the inception, relative to even the current quarter. As I mentioned, here's our only underperforming group, which is income, our income portfolio. Quite honestly, I think it's held up pretty well, considering that you almost have to get into underperforming sectors to get the kind of dividend yield you want, like the consumer staples, financials. You can get some decent dividends in some of the bank stocks and so forth. But even the financials haven't outperformed the S&P 500 by much over the years. So it's different strategies, different styles, but you can always come in here and check how we're doing in these portfolios. This isn't about our ETF portfolio, but I'll go ahead and mention we have an ETF, model ETF portfolio as well, which is close to the S&P 500. We're beating it this quarter by a couple percentage points, but we're trying to make up ground and outperform. That's really a hard one to outperform because we don't control the stocks. When you buy an ETF, you might have 100 or 200 stocks in the portfolio and you have no control over which ones. So trying to outperform the S&P with a ETF portfolio is challenging. But outside of that February to May quarter, we got hit pretty hard in this model ETF portfolio as well, because we were favoring growth stocks, and growth stocks absolutely got trounced. And if you were in growth stocks, you know what I'm talking about. I mean, it didn't matter which ones you were in. They all got, there was just baby out with the bathwater kind of a thing. So there's our portfolio performance for this quarter. I also wanted to show you, this is the 10 stocks currently in our model portfolio. And I went back 3 months. So this is the return for the last 3 months. So this isn't the return since we selected these stocks, because they went into our portfolios on August 19th. So this 3 month takes us back to August 12th. So it's not exactly, but it'll give you a flavor of what's been working. and what's not. You can see Snap, came out with some bad earnings. And some of you might say, well, why wouldn't you just put in a stop and be done with it at that point, and not keep it in the portfolio? This is a good time to explain why we started these portfolios in the first place. I'm a trader. I like to trade short term. I'm a momentum trader. I don't hold stocks for 90 days. I can't. It's not in my blood. For some of those reasons, I don't. If I have a stock and it's breaking below a key support level, I don't want to hold it. It's just not what I do. I just take my loss and move on. Sometimes that hurts me. Sometimes it helps me. But I don't like being in a stock that I think could be starting a downtrend where the momentum's going against me. But we have a lot of members at Earnings Beats that, they work full-time jobs and they don't have time to sit in front of a computer and watch these stocks. And so they were getting frustrated because, at the time we were much more trading oriented. And so we would send out, something in an email saying, hey, the stock's broken down, we'd take, we'd use a stop, get the heck out of it. Well, somebody who's working all day doesn't have time to go through their emails and look at the stuff. So they're seeing it later that day, or maybe even a day or two later. And now the stock's down even further. And they're like, now what do I do? And so they were constantly, being confused because they can't watch the market on a daily basis. They don't have the time to commit to it. So essentially what they're saying is, hey, we like this leading stocks and leading industry group theory, but give us some stocks we can hold for a while. And that's how these portfolios were born back in 2018. Model portfolio started because folks were saying, there's a lot of stocks on your chart list. There's a lot of things you like, but give me your 10 best ideas or give me your 20 best ideas. And so when I would look at the charts, I would say, okay, well, right now, based on momentum, based on the leadership in the market, these are the stocks that I like. And that's how we started the model portfolio, putting one stock in 10 equal weighted stocks in 10 different industry groups. So we're getting representation throughout different areas of the market, but we're still somewhat concentrated in technology and in communication services and in consumer discretionary, financials, industrials, mostly. And then maybe a couple of other areas, we'd get a stock in there from time to time. But if you're investing in leading sectors and leading stocks within those sectors, it's easier to beat the S&P 500. I'm not going to say it's easy because you still, there's just stuff that happens. The market, nothing in the stock market's easy. But I think what this has proven, what these portfolios have proven, is that over time, they do well. Month to month or quarter to quarter, it's a little bit more of a crapshoot. We've certainly beaten the S&P a lot more than we've underperformed it, but it's certainly not a slam dunk every quarter for each of the portfolios. But if you look at this, you'll see AMD up 38% in the last 3 months, Crocs 25%. And Crocs, by the way, if you were employing stops, you might have gotten stopped out. Let me pull that chart up here. I mean, we were down below the 20. We were down below the 50. We lost this support level. I mean, it would have been easy to have been stopped out of Crocs. And for somebody who doesn't want to follow the market, just wants to, maybe rebalance their portfolio every 90 days, that would be frustrating to get stopped out in the 120, 130 and, a month later be back at 180. So what we did is we said, okay, we want to be transparent. We want this to be easy for our members who don't want to trade. Listen, if you want to trade, and I trade a lot of these portfolio stocks personally, because they're my favorite stocks. That's why they're in these portfolios. So it's not that I don't invest in them. I'm not somebody who's going to buy and hold for 90 days. Now, my daughter, who follows these portfolios, she actually has the model portfolio. And, she took the strategy of I'm going to put half my money in the model portfolio and I'm going to put the other half in the S&P 500. Hey, that's a great way, little modification, get a little, flavor of the portfolios if they outperform, but also a little bit more cautious, sticking with the S&P 500. And she doesn't have the same aggressive mindset that I have. I can tell you, I'm an pretty aggressive trader. I mean, I'm not a, go put options on margin kind of a trader, but I can take pretty big positions on a percentage basis of my overall portfolio, which I think obviously is aggressive. But I'm only going to do it for a period of time. I'm going to keep stops in play and so forth. But, when you look at a stock like Crocs, what do if you had stop in play, I guarantee if I had set a stop, this stock probably would have gotten stopped out. Now, maybe not when we put it out in August, maybe I'd gone into this gap support zone and just said, as long as that holds, I don't know, but it's possible I could have set the stop maybe at 130 and might have gotten literally stopped out by one day. So stops are up to each individual. Again, we're not registered investment advisors. We're not telling you to buy. We're not telling you to sell. We're not advising you to do anything. We are providing all of this information for educational purposes. And then our members can do whatever it is that they want to do with it. And trust me, we get a lot of emails. A lot of members do different things with these portfolios. Some trade them, some trade options, some hold and follow the portfolios. We've got individual investors, we've got older investors, younger investors, we've got professional money managers. Everybody does things differently. And I always like to say too, I believe it's irresponsible. It would be irresponsible for us to be advising, because there's so many different folks in our membership with so many different objectives. How could we possibly have one system that is appropriate for everyone? I mean, you have to be thinking about your own financial situation. I don't know if you, for instance, have a portfolio that you can't, you're unwilling to lose money. You don't really want to lose your capital. Well, that's a completely different animal than somebody who maybe is younger and is shooting for the fences. So anyway, so that's our model portfolio. I'm going to swing through these others just real quickly so you can see these. Right here, over the last 3 months, let's get this percentage. I mean, look, you want to know why our aggressive portfolio has done so well? We've got 4 stocks that are up about 50% each over the last 3 months. And we have 1 bad stock in here, Moderna. Moderna was doing well for a while, but it's kind of fallen apart. But that's the idea with these portfolios, is that what we're hoping is that we'll have more of these types of stocks and less of these. So this quarter, we've got 9 winners out of 10 stocks in our aggressive portfolio. 4 of them just crushing it: Macy's, Nvidia, Datadog, and Synaptics. Income portfolio. Now, as you might suspect, you're not getting big moves up or down. Microsoft, which we put in there just to kind of give this portfolio a little bit of juice, because we realized that, hey, if you don't have Apple and you don't have Microsoft, the way these stocks have been going, they've been leading the NASDAQ and outperforming the S&P 500. If you don't own them, it's almost impossible to beat the S&P 500. So we added Microsoft to it. You can see this is one that's lifting. It's keeping our income portfolio close to the S&P 500. Without it, well, I mean, we'd lose our top performer. But all of these are dividend payers. And you can see that they're not as volatile, which is what this portfolio is designed for. But it is underperforming a little bit this quarter. Our strong AD portfolio is simply based on companies that have very strong AD lines going into the portfolios when we announce them. And these do not have to be, they don't have to beat earnings and revenue estimates. All the other portfolios, the 3 others, have to beat Wall Street estimates in the last quarter or they're not eligible. This one's different in that we can select companies that just appear to be getting accumulated, even if their earnings weren't so great in the last quarter. You can see 3 big winners and 3 decent sized losers, but our 3 big winners are just carrying the portfolio. 67% winner. You have, 1 stock in your portfolio, it's up 67% in 3 months. It's going to help you outperform. And if you get a couple others that are doing really well like that, that's how you outperform the S&P 500. So what's interesting about this portfolio is 7 stocks in this portfolio are underperforming the S&P 500. 7 out of 10 are underperforming, and yet we're up 8 percentage points or 9 percentage points. What was it? Almost 9 percentage points this quarter on the strong AD. So pretty interesting. And then our other portfolio, which we actually just announced, I'll give you a little bonus here. We just announced this last week, but we have a earnings reaction portfolio that we just assembled. And look at now over the last 3 months, let's just do the last week because these were just put in here. But look at Trek's already up 13% in the last week. I mean, we've gotten off to a pretty good start in this particular portfolio. So those are portfolio results. Let's move on. And let's see, what else did I have here? All right, yeah, I think that's it for the results. What I want to do now is just go into the fourth quarter themes. So some of the things that I'm going to be thinking about, over the course of the next week or so, or this coming up this week before we make our selections. These are some things that I need to keep in mind. The first thing that I need to keep in mind is that the fourth quarter, and I'll go ahead and give you a different chart to look at because we're going to be talking about this one in a minute. But the fourth quarter is historically the best quarter of the stock market. On the S&P 500 since 1950, the October 27th close to the January 18th close, the S&P 500 has gone up during that period 60 of the last 71 years. That's what, 85%, something like that. 60 out of 71 years. So we're in a sweet spot historically for the market. November's been the best month over the last couple of decades. November performance has been the strongest of all months, that in April. So, we're in a strong month, we're in a strong period, we're in a secular bull market. And as I go through and show you some of these other charts, you're going to see we're showing no signs right now of slowing down. This first chart I'm going to show you, consumer discretionary versus consumer staples. How are the aggressive discretionary stocks doing versus the defensive staple stocks? Consumer spending represents 2/3 of our GDP, roughly 2/3 of our GDP. So is it the aggressive area leading the defensive area? Because if so, 2/3 of that GDP is coming, more than its fair share is coming from consumer discretionary, which is going to drive our economy higher. It's going to strengthen our economy, which in turn is going to send profit soaring, which in turn is going to benefit growth stocks who can grow their stocks the fastest. So look at this ratio. Look at the ratio bottoming at the end of 2008, right before the market turned. So right here, we got a lower low on the S&P 500 in 2009. But look at the positive divergence we have. Money actually started rotating into discretionary stocks as we were putting in that final low. Now, one thing that I think is really interesting is that when we started that really big financial collapse and that last leg of the nasty bear market, we did so. I want to show you the warning. So I'm going to drag this line right to the top right here of the S&P 500. And I want you to take a look at what was going on with this ratio, the XLY, XLP. Literally just past the top, the all-time high, just past. Look at what happened here. So we were breaking, actually, I could move it just right up to here. Right here, we were breaking down. See, as this line goes right here and crosses right there by December, maybe in November of 2007, this ratio, the XLY, XLP, was at a 5-year relative low, while the stock market was trying to make a breakout to an all-time high. Why is Wall Street going into consumer staples instead of consumer discretionary if things are looking so bullish on the S&P 500? These are the types of signals that you get under the surface of the market that you don't hear about on CNBC. They don't tell you anything. They're cheerleading right here, telling you, we're going to an all-time high. And meanwhile, Wall Street is selling out of consumer discretionary stocks at a 5-year relative low to consumer staples. Pretty amazing. But look at what we're doing. I mean, yeah, we got hit during the pandemic. That's a once in a lifetime type of thing. But if if we just kind of say, hey, that, just act like for a minute that never happened, because the stock market rebounded like it never happened. But let's just assume it didn't happen. And you're looking at this going straight up and just broke out to new all-time highs. This is completely different than the top we saw back in 2007. So I don't see anything yet that suggests to me that we've got any kind of problems. Now that's that ratio. I got another ratio I'll show you. How about transports versus utilities? Now, transports versus utilities, if you notice, we're setting an all-time high right now, along with this. That was one of my bigger concerns, was that recently we were pulling back and transports weren't doing very well while the market was going higher. So this was one of those charts that I was still bullish, very bullish, but I wanted transports to come along for the ride, because transports help us in terms of, transports can't go higher if our economy is not strong. If less goods are being shipped, how are transports going to do well? So when transports are doing well, it's telling us that the market is anticipating a strengthening economy. And right now we're breaking out to new highs, along with the XLY XLP ratio breaking out. We also have transports versus utilities breaking out. Now you look back and you say, well, yeah, this one's a little bit choppier. Yeah, I don't disagree. It's not my favorite ratio. It's not as strong, I don't believe, as the XLY XLP, but I do think it gives us some really good signals. If you look back at, say, look at the late 90s, one of the best bull markets that we've seen, transports were very strong versus utilities up until about 1998. And then they started rolling over. So I think overall, that move right there is telling you that if transports are doing better than utilities, that should be a sign of a strengthening economy. Now, throughout the, that secular bear market that we were in from 2000, 2012, you can see we didn't really do anything. We never broke out. Remember I said April 2013 is when we broke out. That was the confirmation of the secular bull market. Well, we also saw a breakout in this ratio in 2013. It was a little bit later in the year, but this ratio broke out that same year. So further confirmation that we were in a secular bull market. Now, when we have problems in this ratio short term, normally it coincides with some issues in the market, which makes sense, because if transports aren't doing well, something's going on. But here you can see we went down. Look at the choppiness, 2015 and 2016. That accompanied this downtrend in this ratio. How about the trade war and the pandemic and everything we went through these 2 years? Look at the ratio. It was going down. Now I want you to look at what the ratio is doing right now with the S&P going higher. Just broke to a new all-time high. I think this ratio is going to look very similar to this over the next several years. I think transports will do very well because I think our economy is going to remain strong. But doesn't mean we're not, a recession is just 2 quarters of negative GDP. All you need is 2 quarters. And trust me, that'll scare the heck out of people. We'll get one. Will it be in 2022? Well, stick around for that Market Vision 2022. I'm going to talk about that a little bit. Anyway, I like this action here. So again, these are the themes we're talking about. Consumer discretionary outperforming. Transports outperforming. These are great signs for the market. We're historically in a period where we have the best performance of the year. How about growth versus value? Well, these ETFs started during the secular bull market or bear market. So it doesn't do well. Growth doesn't do well in a secular bear market. But guess what? Since about the end of 2008, after we had that first move up beginning of 2009, that was another factor, by the way. We went lower from the end of 2008 to here's the S&P 500. See how we're going lower and money is rotating into growth stocks? Why in the heck would you do that? unless Wall Street believed the market bottom was in. So that was another nice little positive sign. But look what's happening. And this is what happens during secular bull markets. Growth stocks should be in favor. And I know, back in February, we had the whole inflation scare. Inflation is horrible for growth stocks. Those future earnings are all eaten away as inflation picks up steam. The other thing is it drives interest rates higher. When inflation is high, or when there's fear of inflation going higher, folks sell bonds. That sends yields higher. What do you think yields do to the value of future earnings? When yields are rising, I can tell you from my prior days in the CPA world and valuing companies, when interest rates are going up, valuations come down. Now, it's going to take a lot of movement to the upside, or a big, surge quickly in interest rates, in my opinion, for it to really derail the stock market. And we might get a little bit of that in 2022. We'll see. But we're still going to be near historic lows. I don't see Treasury yields going to 3 or 4%. I see them maybe 2.5% at some point, probably as a result of what's going on with the short-term inflationary pressures and so forth, and with the strengthening economy, by the way, which you don't hear about much anymore. It's all about inflation. Anyway, growth stocks since February have been going higher relative to value stocks. Even though we had that rough period right here, this was that period from February down to May, we've gone back up and we're now higher than we were back in February. Why would we be doing that if this is the start of a big inflationary period? So once again, what you hear on the news is not what Wall Street's doing with their money. Complete disconnect. Anyway, this is another thing pointing to me. We want to stay long. Not only do we want to stay long, but we want to be aggressive. All right, let's pull up the small cap index and let's go back. Everybody kind of loses track of the small cap area because we just didn't do anything for a while. S&P 500 keeps going higher and higher, and small caps don't. And so you're just like, oh, they're horrible performers. You won't want to be involved. Well, when they break out, you do, because they tend to start new uptrends. So when you're looking at, something like this, and let's go back 10 years, pull up a weekly chart. And when you look last 10 years, here's 2013. So we've almost tripled, since 2013, 500 to 1500. So it's probably outperformed the S&P 500, or at least performed alongside it. But after this big move up and sideways consolidation, we just broke out. I think that's pretty important. I mean, look at here. Back in 2017, we had this move up, went sideways for about a year. We broke out. When we broke out, we went from about 860 up to 1100 in 9 months. That was maybe 30% move in 9 months after we broke out. So I think this is a kind of a big deal. And I wouldn't be surprised if over the course of the next year, we see small caps moving up to maybe 17, 1800. So I'm not going to be afraid to maybe have a small cap, a few small caps in our portfolios as a result of that breakout. Same thing with the mid cap index. So here's your sideways consolidation. Here's your mid cap breakout. All right. And then the last thing that I look at, and probably I don't want to, this is probably the most important thing, or one of the most important things, is relative strength of sectors and industry groups. So here's a weekly relative strength chart. Technology just broke out relative to the S&P 500. Yeah, Wall Street's really worried about inflation, jumping into technology and sending it to an all-time high. Consumer discretionary just recently went up, hit an all-time high versus the S&P 500, pulling back in the short term, but I actually think that's presenting an opportunity. But once again, a growth area breaking to a new high. This was the February through May period. So you can see, really taken out. Look at technology, February to May, growth stocks. You start talking inflation, you start talking higher interest rates, and that's what's going to happen. But we didn't stay down. Both these areas have come back to set new highs. We still have inflation. So what this tells me, I mean, charts tell us stories. And the story this is telling me is that Wall Street is, couldn't care less about the inflation worries that are out there. And I think the inflation is used in the media to bring prices down. I mean, the biggest conflict in the stock market is these big investment firms like Goldman Sachs. They make markets. So when you buy or sell and nobody's on the other side of the trade, they'll take the other side of the trade. So they've got a vested interest in the stock market, number one. They also manage money for people. And then number three is, they have these research and this research department, they have the analysts and so forth that are coming out and telling people what to buy and sell and going on CNBC and promoting it, while literally at the exact same time, potentially shorting stocks that they're telling you to buy. I mean, think about it. If Goldman Sachs comes out with a buy recommendation and everybody decides to buy, well, guess what? Goldman Sachs, they provide liquidity, so they have to take the short side. I mean, is there a bigger conflict in the market? I don't think so. But anyway, digressed a little bit. Communication services. Now, communication services, and I talked about this when we started losing ground back in September. This is a group that had been doing really well for the last few years. So I'm not surprised by a pullback, but also don't be surprised when internet stocks or some other area begin to pull this group back to the upside. I'm looking for communication services to begin to outperform again. I'd be looking maybe down here at this triple bottom. Maybe we can go down a little bit further, but I think most of the relative weakness is already built in there. Then you got industrials, which I believe this -1, I'm going to just show you, go back, 10 years. But if you look at the relative PPO on a weekly chart, every time we get down to this -1 level, right in here, that's where industrials tend to start gaining strength. And that's where we start bouncing off of these relative lows. So right now we're at this -1 level, and we just saw transports just break out. The XLI just broke out on an absolute basis. Here it is. Sideways consolidation. We finally broke out above that 105 level. So I think this is the start, and I think you're going to see this relative strength pick up. So might I want to consider a few additional industrial stocks than I normally would? Yeah, I might. I mean, industrials over the course of the last 8 years have outperformed the S&P 500, but they're not a major outperformer. So I don't want to say, well, I'm going to just load up my portfolio with industrial stocks, because historically it's not like they're great relative outperformers. But I do think from where we sit right now, the next 3 months, we could get a nice little pop out of industrials. Financials, going to depend a little bit on the interest rates, but we're in an uptrend. We've pulled back recently. I think financials are fine. I think they'll probably outperform. I just don't think you're going to see them, shooting higher. Healthcare has been underperforming. Got to be careful there. Consumer staples, that's what we talked about earlier. Consumer discretionary set a new high. Look at consumer staples relative to the S&P 500. This is what happens during secular bull markets. Real estate. Well, real estate's not done too bad in 2021, but 2020 in the long term is mostly downtrending because, again, they don't perform well. They're defensive. They don't perform as well in a secular bull market. Utilities setting new 52-week low. Actually the last few years, probably multi-year, many-year low on a relative basis. Now you got energy. So energy's had this big move off the November bottom of last year, but we haven't taken out that March high on a relative basis. You can see on an absolute basis, we've been going higher, but since March, energy's actually underperformed the S&P 500. A lot of folks, wouldn't realize it, but we're breaking out. We should be breaking out on a relative basis, and we're not. And if I was in energy, I'd be a little concerned about that as we start to roll over potentially on the absolute chart. Now, if we can continue going higher and this group breaks out, then I think energy on a very short-term basis could set up for some nice trades. And I'm not saying we haven't had nice trades, because we have, but keep in mind the S&P 500 has been solid. The best trades in energy came from November to February of last year. That's when energy crushed the S&P 500. September, the energy did well, but remember the S&P was taking a big hit. So we saw money rotating out. and into energy, but it still could not forge to a new relative breakout. And then you got materials. Materials were doing really well off that pandemic low for about a year, a little over a year, but we've come back down. Now we're talking inflation again. So the group has broken out. We're starting to show strength. But from the May, when we had that real scare for inflation, that's when the stock market, the growth stocks in early May were performing so poorly. That money was rotating into materials. We're not seeing it to the same extent nowadays. Now, maybe we'll see it. Maybe the next few months, inflation is going to continue charging higher and money's going to rotate out of the key aggressive areas again. But that would be odd from a historical perspective. And it also would be odd considering transports are breaking out. Industrials have just broken out. Consumer discretionary has been on fire. Technology just broke out relative to the S&P 500. I'm just not believing that materials and energy are going to be the place to be. So short term, you might get a little pop because of the inflation news in the media, but I just don't think it's going to be a good long-term solution, and mostly because I believe the dollar goes higher. One other thing that I'll mention here as far as themes go, and then we'll move on. But if you look at the dollar chart, look at where we are right now. Going back, this is just the last 2 years, but we are now at a 52-week high. And if we break above this 2560 area on the UUP, that will put us at about, I don't know, what is that, about 16, 17-month high. So the dollar, which long-term I think is in an uptrend. Short-term, we were in a downtrend here, but longer-term, we're in an uptrend, in my opinion. And I think we're starting to move back to the upside. So with the dollar moving up, I think we've got to be at least cognizant of the fact that both materials and energy could underperform going forward. All right, last thing I'll show you here in terms of themes is, in addition to looking at sectors on a relative basis, we have a chart list that we provide all of our annual members that you can use. It's got all 104 industry groups in it. I've got it set up so that the first 7 or first 8 are industry groups within technology. And then you've got the next 20 industry groups are all in the consumer discretionary area, and then communication services. So I've kind of got it listed in order of aggressive groups and then defensive groups. But you can see, so computer services have not been performing well relative to the S&P. There might be an individual stock or two that's been doing really well, but you have to know that the overall movement in the industry has been to the downside. However, look at semiconductors. Now, I showed you in a couple of the portfolios, NVIDIA and AMD, that they're carrying our portfolios. Well, part of that was because we know semiconductors tend to do very well during these secular bull markets. And if you look at the relative chart, I mean, outside of, a couple of brief periods, here was the inflation scare. Semiconductors are full of growth stocks. So we had a little bit of an inflation scare there. Look at the inflation scare now. Yeah, everybody, we just had a report last week. Inflation's horrible again, right? Just set a, 30, 40-year high in inflation, annual rate of inflation. Look at semiconductors. Does it look like they're worried about inflation? Here was the inflation scare, and the market did go down, briefly, 3 months, parts of the market, I should say. But now we've got inflation numbers high, and yet one of the highest growth areas of the market just keeps going higher. Are you hearing about that on CNBC? I mean, I wouldn't know, because I don't listen. I won't listen. It's a lot of it is worthless information, cheerleading, fear mongering, but rarely is it educational. Sometimes they have some really good guests on there, but rarely would I say is it educational. So when they start talking inflation, what I would like to get on the CNBC and ask somebody is, okay, well, inflation was really soaring through the February through May period, and we saw all the growth areas getting hit really hard. Now we're seeing the same thing in terms of inflation numbers soaring and all-time highs or 30-year highs. Why are the growth areas breaking out to new 52-week and all-time highs? That'd be a great question. You know, why would growth stocks be doing so well? Anyway, but you know, this is the other theme, is to go through these 104 charts and look at the industry groups like semiconductors, like software. Here's software, another high growth area breaking out to new highs. The real struggle for software was February to May. This group has come roaring back. How about, you know, moving on to something like, well, even renewables, which had been really weak. Now look at renewables starting to turn back up. Look at the relative PPO go positive again. Last time when it went positive, the relative strength was down here. Look what happened afterwards. The time before that, when it went positive right here, look at what happened afterwards. So we're in a stage where I think it makes sense to take a shot with renewable energy. If renewable energy outperforms like it did the last two times it started gaining strength, and you're in a leading stock in this group, it could get really exciting. I mean, it could be one stock that helps carry the portfolio. And if it doesn't work out, well, it's one stock. And so you hope your other 9 are doing well enough to pick up the, you know, pick up that slack, if you will. But, you know, I like what renewable energy is doing right now. And this is something, by the way, we've been talking about. 240 was the level I was watching on renewable energy when I was writing in the DMR and in my blogs and everything else. When we started moving up here, I wanted to clear 240. Well, we cleared 240 a month ago, and now we're 290. This group is kind of like semiconductors. When they get on a roll, they go. They get, you know, they make very swift moves over fairly short periods of time. How about another area I'll give you? Home improvements in the consumer discretionary area. Trying to make this relative breakout, but we've been strong. We've already made the absolute breakout. So I like this absolute movement to the upside and also the relative movement, but we do need to still get that breakout. This is a group I think strong. Let's see, what else do we have? Specialty retail. Been strong now for about 6 months. And notice when we really started picking up on relative strength, it was right after we got this breakout right here in early August. Once we got that breakout, look at what happens. So you do have to pay attention to the absolute breakouts, because that normally will trigger a relative response to the upside. And if it doesn't, like with energy, that's when I grow a little bit more concerned, because if you're breaking out the new highs, you should see more money rotating into your group, and that should drive your relative strength to new highs. All right, next up, what else do we have here? How about, business training? I mean, this is a group that's, since the March low, pandemic low, we've been moving up really nicely. Business training and employment agencies. Everybody was out of work. And of course, this area got crushed, but now we've been strengthening in employment for quite some time, and this area has been strengthening right along with it. Automobiles just broke out to a new high, huge move. Of course, that was a lot of that was influenced by Tesla, but Tesla is not the only auto stock. There are others that look really solid. So this is the whole idea. I'll give you one more. I'm going to go into communication services and take a look at internet. So internet tends to be very strong, but we go through these periods. You know, here was a move back in 2019, about 6 weeks. We didn't do very well on a relative basis. Here, this was more like 10 weeks, didn't do well on a relative basis. Here, about 6 weeks, and now we're starting to turn back up. So internet could certainly be leading communication services going forward. Probably going to want to make sure I have an internet stock or two among our 40 stocks that we pick. All right, so those are all the themes. So hopefully you can see why I'm bullish and why I want to be in certain areas and how we get the performance we do. It's not, I don't think it's luck. There is some volatility involved, but I think over time, if the call is correct about being in a secular bull market, I believe the aggressive groups are going to lead, and we want to continue overweighting those areas of the market in our portfolios. So while we may only have one software stock in technology, we may still have a semiconductor stock, and we may have a renewable energy stock. So we could have 3 of those, and all of a sudden 3 out of 10 become 30%. Well, 30% in technology is better than the S&P 500, which is 24%. So we're overweighted, and we're overweighted in 3 leading industry groups and 3 leading stocks within those industry groups. So we're looking for that area to help carry us, just like we saw with AMD and NVIDIA and some of those others this last period. What else? I think that's it for the themes. So now let's move on and talk a little bit about stocks. Stocks to consider. So I'm going to start with those semiconductors. So what we do, or what I did in coming up with some of these stocks and where I start is a lot of times I will go into, I'm going to pull up our strong earnings chart list. Now I have added, let me find it here first. I went too far. Here we go. So I am in the process, hopefully by the end of this weekend, I'll be able to get our new strong earnings chart list out to everybody. It's been about 2 weeks, maybe just over 2 weeks. There's just been so many earnings reports coming in. There's so much to do. It's just hard to go through all these reports and get everything. I'm in the process right now of annotating over 300 charts just for the strong earnings chart list. So, but I'm in the process, and this does include more charts than the strong earnings chart list that you all have right now that you've downloaded from our website. So I'm going to work off of this new one. I think this goes through, I want to say it was like 86, 85. Well, I can tell you. Let's go to November 27th. So, or October 27th. So in here, the last chart was 86.75. So in this new list, I'm going to scroll down, and I have gone, there's 86.75. So here are the stocks I'm adding. I'm in the process of adding these right now. And so far I've added 117. So I probably still have another 200 charts to add and to also annotate. So there are 200 that are missing from this chart list. So when I start sorting, remember, I don't have all the charts that I'm going to have to pick from for next week in the draft. But what you can do, which is really cool, is you can take this chart list and update it by scooter. And you look at this and you say, well, why do you have CAR on here twice? Well, CAR was number 8206 and it's 8729. That 8206 is one of the older ones. That'll get removed. When I update this chart list, I'll go through and actually take off some of the others that have just reported again. So right now, there are 2 charts on here, 2 CAR charts, because it just beat earnings recently, and I like the chart, so I wanted to put it in here. And they also beat in the prior quarter. So this is an old one that'll get removed. It's kind of like a revolving door, this chart list. So the old ones fall off, and then as you beat again, you get re-added. Well, if I haven't taken the old one off yet, that's how you can get 2. And right now, there's probably a number of them that are like that. Trying to see if there's any others that I can see off the top of my head. I don't see any, but there are plenty of them on here, I'm sure. Anyway, so I start with setting up in scooter order, and I know semiconductors are a group I want to look for. So I go right into this strong earnings chart list. And remember, 3 of our 4 portfolios have to come from this chart list. All 30 of those stocks are going to come from this chart list. This is the chart list that houses every company that beat Wall Street's estimates as to both revenue and earnings. There's got to be something compelling on the chart technically, and they also have to be liquid. So I'm looking for companies that have probably at least an average of 200,000 shares over the last quarter or so. And I'm usually eyeballing it, so don't hold me to that 200,000. I'm looking at the chart. Some days might be under 200,000, but it looks like more days are over 200,000, that kind of a thing. Then I probably would include it. Although if it's really that close to being what I would consider illiquid, I wouldn't include it in the portfolios. I don't want to go with stocks that are borderline illiquid. Anyway, so now I've got the semiconductors up, and I've got these coming up in scooter order. Scooter is just a quick little relative strength indicator for me to say, hey, these are stocks that are performing better than the other stocks within the asset class. So in this case, NVIDIA's large cap it's being ranked against other large cap stocks. Some of these others like MXL, I think that's probably small cap. It's 98.6 is because it's being ranked, in the top 2% against all small cap stocks. So it's not semiconductors being ranked against semiconductors or NVIDIA being ranked against the S&P 500. It's really about stocks within your own asset class. But this will give me a pretty good sense. If I go down and look at these charts, it's going to give me there's another one right there, LSCC. It's on here twice. ON is on here twice. So there are going to be some of those. UCTT is on here twice. Anyway, but this is going to be a starting point for me to pull up because I want the best performers. And it might be counterintuitive to some of you who think, well, these stocks have run up so much, I don't want to be in them. Well, Wall Street's getting in them. And so if Wall Street's getting in them, chances are I'm going to want to be in them as well. So let's pull up the charts. Just a few of these. I'm not going to, do too many of them, but we got NVIDIA. And actually, let me, well, this will work. So NVIDIA just made a huge break to the upside. There's a decent chance that this stock is going to be in one of our portfolios again. Now, if we pull back over the next few days, then we'll lose out on the current portfolio because this is one of our portfolio stocks right now, but it'll save us on the next portfolio. If it keeps going up, then it'll help in the current portfolio, but then we'll be even more overbought for the new portfolio. Sometimes if I see a stock that looks bad, like on a weekly chart, sometimes I'll even go out to the weekly. And if I see a negative divergence, which I don't see here. Now, some might say, well, this is still lower than that. No, I don't look at it that way. I look at this as being a negative divergence. We go down to the 50 period, we test, and now we're strengthening. We're actually going higher. And we just recently went to a new high on the weekly PPO. So I'm not seeing the way I look at PPOs and divergences. I think that the divergence here is fine. I think we have a really strong stock in terms of momentum. Volume trends are great, but we're very overbought. But let me tell you something. We were overbought right here in May of 2020. And from that point, being overbought, we went from 90 to 150 in 3 months. So if we had it in our portfolio there, we would have been overbought on a weekly chart. I mean, I don't even know what the daily chart was looking like. What is that? May of 2020. So let's go back and take a look at that. So in May of 2020, right here, we're breaking out on NVIDIA. So if we had, and look at, it was overbought on the daily chart. So if we had bought, it wouldn't have mattered because even though prices are going up, the RSI is coming down. I mean, RSI, all of these momentum oscillators are computed differently. And, I don't want to get off track because I've got so many other things, other stocks we want to look at. But my point here is overbought doesn't mean a stock can't keep going higher. Maybe in the short term, it might present a little bit of risk. I mean, right here, it gets up here, and you can see it does pull back. So you might say, well, it's overbought. I like the stock, but I'm going to wait for a pullback to get in. Hey, that's fine. Again, these portfolios, we get in them the day we talk about them, and we hold them for 90 days, no stops, because we want to be transparent. We want it to be very easy to use, but that doesn't mean that you can't take it and, adapt it to your own strategies. You might look, we might include NVIDIA on Thursday, and you might say, well, it's just overbought. I'm going to wait until I get a 20-day test before I get in. Okay. We're not going to do that because, again, a lot of the folks that we created these portfolios for are not sitting at their computer waiting for tests of support or moving averages or trend lines. They're working. And so we get into strong stocks, we hold them for 90 days, and we get out of them. And then if they keep performing well, maybe we get back into those same ones again. We'll see. All right. So that's NVIDIA. Now I took a little bit more time, but I want to go through a bunch more stocks with you. So let's go through some of these other semiconductor stocks. So here's AMD. I mean, I'm going to pull this up on a relative chart. So what we're looking for are charts that are just going up from left to right. So the AD line, I would prefer that it's going up. Doesn't have to, with one exception. The strong AD portfolio is based primarily on the AD. So you're going to see all of the AD lines look very strong there. It's helpful if they look strong in these other portfolios, but it's not a requirement, because again, the requirement is based on relative strength and the fact that they beat earnings and revenue estimates in their prior quarter. And then we're trying to get them within certain industry groups that have been strong. But here's your AD line strengthening. Here are semiconductors on fire. Here's AMD relative to the semiconductors. So here's the group going higher. Here is the group relative to the S&P going higher. And then you've got a leading stock within the group. So when AMD went soaring for us, it wasn't really a big surprise. Leading stocks tend to go through these periods where they're almost unstoppable. And you could look at AMD and say, well, you know, after this huge move, I mean, if I pulled up the RSI, it probably would be overbought almost this entire time. But if you sold because it was overbought, you missed out on most of the move to the upside. So AMD looks strong. How about Ambarella? Ambarella has been going straight up. And again, relative strength everywhere looks pretty good. We've actually pulled back a little bit as we consolidate here on Ambarella. MXL, I'm going to try to wrap this up, by the way, in about 9 minutes for those of you who are interested in timing. So we're getting close. I'm literally just going to try and fly through some of these charts. These are stocks that may or may not make it into the portfolios on Thursday. And I'm looking specifically at some of the leading industry groups within the leading sectors, those three aggressive sectors that I talked about. So here's Max Linear. Look at the volume coming in up. Volume was strong. We made the breakout, moving up. But look at the relative strength, just shoot higher. So again, leading stock within the space. And this is why these stocks, by the way, have such strong scooter scores. You can see it's pretty obvious by their price action. Here's Xilinx. Xilinx moving up. And again, you got strength everywhere. Then we've got Wolf. This is one that until recently I'd not even heard of. Wolfspeed, big breakout. Look at the volume, strongest volume in a year. And look at that hollow candle. Wolfspeed was added to our earnings reaction portfolio. The earnings AD, you know, where we were tracking the accumulation distribution on the day after earnings. You have to have a hollow candle. Well, look at this move to the upside. Now I expect you're going to see some volatility in this stock, but I also believe in time it's going higher. But by itself, it's a risky stock. It's not a huge company, and it's already made a big move. It's overbought, but we just made a breakout above these prior highs, and the relative strength was going down. But when earnings came out, it started to turn up right before earnings, and then with earnings, it just shot higher. So we'll see, but I think Wolfspeed looks interesting there. Let's go with a couple more of these semiconductors. How about Lattice Semiconductor? I love this breakout here. Would like to see a little bit more volume, but AD line supports this. And of course, all the relative strength looks good. On one of the better reports I've saw in the semiconductor space, look at the volume again. Huge gap up from 48 to about 54. Big volume. And normally when stocks gap up, market makers get control, you know, of the gap up, and they're selling at the open. That's why many stocks will come down after they gap up. Look at ON. Heavy volume just kept going higher for 4 or 5 days. So I think major accumulation, anything back down near that 20-day or near that gap support around $54 would be very interesting on ON. Let's do one more. One stock that I featured recently in the EB Digest was SGH. I mean, this stock had been sideways consolidating for a while, just recently made a nice breakout, and the relative strength, while it's not been great, did bottom a few months ago. And now that we've gotten this breakout right here, I'm going to be watching this relative strength, but I'd like to see that move up and take out that high from back when the earnings come out. The earnings actually came out here with this gap up. Notice when we pulled back, where did we pull back to? Top of gap support, not the bottom. We never went back and filled all the way to the bottom. We stopped at the top and then turned higher. All right, how about software stocks? Talked a lot about software and semiconductors. So let's look at some of these big winners. ASAN, you can see the AD line strong, software strong, ASAN very strong relative to software. Again, leading stock in a leading industry group. These are the types of stocks that I'm going to be looking at. Cloudflare, huge winner. This was in one of our portfolios. It's been a great stock for us, moving up. AD line, software. You can see once again, everything's strong there. Unity just wrote about this in Chart Watchers. I love all this volume coming in, just making this breakout over here. Yeah, we're probably going to have a pullback at some point, but look at the strength in this stock. All of a sudden, just exploding relative to its peers. So Wall Street's putting a lot of money into this company for some reason, and I don't think it's to lose money. So this is a company I believe we should be considering. Datadog is in one of our portfolios, just came out with great earnings, gapped up, continues to be a leader. AD line strong. Hopefully you're getting the idea here. All of these lines going up, strong volume trends. All of that is important to us. New Relic, what a gap up on this one after earnings. Good gosh, look at this. Huge volume, big gap up, was trading just over 90. That was after it already ran and after breaking out, heading into its earnings reported a run up from 80 to 90, and then gapped up another $30 when they reported blowout earnings. I mean, their earnings were spectacular. Let's do maybe a couple more. Trade Desk starting to really gain some momentum of late. Look at the move up with earnings, a little bit of a pullback and then a breakout. So here was the top. It looks like we challenged it 2 days after earnings, pulled back, and then on Friday, volume picked up again. We made the breakout. So this is a stock now that looks like it's trying to move to about an 8-month relative high. And Trade Desk, if you look back in its history, when it gets going, it can really get going. Software and semiconductors are going to be the hardest groups for me because I'm probably going to have 3 or 4 of each group in the various portfolios, one in each. And it's going to be hard because there's so many of them I like. It's going to be hard to narrow it down as to which ones to go with. But Trade Desk, I think, looks good. Another one that reported not too long ago, Team, big gap up. This one's actually pulled back a little bit, but it's been under a lot of movement to the upside. Very strong relative performer. Again, just a great looking chart there. And let's do one more. How about ESTC? So this is Elastic. Volume just picked up. We just made this breakout. Sideways consolidation for almost a year. Just made the breakout. So what happens when you sideways consolidate? Well, you don't really do anything on a relative basis. Made a move here off the bottom, but really been mostly sideways consolidating. A breakout to about a 10-month or 9-month high on a relative basis, that would be very bullish, especially after this absolute chart. Notice we're now holding the 20-day. It's just starting to give me a flavor of outperforming. So this one, if I wanted to be a little more aggressive, I might consider because it looks like it's just starting to make potentially what could be a big move. But the risk factor is what if it, right after we add it to the portfolio, it comes back down and loses its breakout level. Then this becomes a false breakout and you got an underperformer. So, then there's that. All right. So that's about it for software. I'm going to give you just a few other stocks in a couple of other areas of the market. So how about something like RVLV, which is in the specialty retail space? Sideways consolidation. Look at the volume picking up here in early November as we make this breakout. So the stock is near a all-time high relative to specialty retail, and specialty retail is turning up. Looks like about to make a major breakout versus the S&P 500. So this one, depending on what happens over the next 4 days, could determine whether or not I include this one in a portfolio. How about Williams-Sonoma, WSM, breaking out, moving to new highs. Just recently took out that high. This was earnings back in August. Big move up, coming back down. Now, I don't know if Williams-Sonoma has reported this quarter. I want to say they either, I don't know if they reported there. I think I did. Yeah, I think I did look at this one just recently. So anyway, I mean, I have to go back and double check that, but you can see the stock making a breakout on an absolute basis, good volume, and relative to its specialty retail peers, it's been trending higher again here for the last 6 weeks or so. A breakout, though, to a new relative high would confirm what we're already seeing on the absolute chart. And I think since we got this breakout on the absolute, it's just a matter of time before we get the breakout on the relative strength chart. All right, looking for others. Let's move on to, how about that business training group? One stock that absolutely exploded with earnings was Cross Country Healthcare. Excuse me. So stock was trading at 22. Earnings came out, it went up to 30. And then look at this pullback. So from 30, the next day it was back down, it filled its gap. That's what I was talking about. You know, most stocks fill gaps. Well, this one filled its gap, and now a week later, it's back up near 26. But this has been in a nice uptrend for a while. Look at the relative strength versus its peers, and look at its peers relative to the S&P. So the business training group just recently set an all-time high, relative high, and you can see it's been trending higher. Well, this is one of the best stocks in the space, leading stock in a leading industry group. Now, I believe this is a smaller company, so this could kind of fit the mold of having a small cap company in one. This could be something maybe in our aggressive portfolio. I would maybe think about a stock like this. But yeah, I mean, I really like what's going on with this chart. Automobiles. I mean, love Tesla. I always talk about Tesla. You know, if I ever had to hold one stock for 10 years and never look at it, this would be my pick. I just believe, I think Elon Musk is a genius. I think they've got such a leg up on all the other EV makers. They basically have, you know, the batteries in their back pocket, all the technology and so forth. But forget about all the fundamentals. I'm looking at the chart, and what the chart's telling me is Wall Street absolutely loves Tesla. I think Tesla the next 10 years is just going to be like Apple was or has been for the last 20 or 30 years. I just think Tesla is the leader. A lot of folks are going to try and take their market share, and I'm just going to say good luck. Because Tesla is probably going to develop other things that are going to be, you know, in their cars. It's kind of like what Apple's done with the phone, you know, and how they've kind of put everything together. They're just the best of the best. And it just, the margin, the difference between them and all their competitors just grows and grows and grows. And I think Tesla is going to do the same thing. But just my opinion. But Tesla with the big earnings report, it has actually pulled back some. And you might think, yeah, but it was $600. Well, I'll be honest, you know, take a look at long-term charts of Apple and look at how overbought Apple got. And it never went back down to those levels. It just kept going higher, you know, after slight pullback. So I think the pullback's an opportunity with Tesla. I think potentially it could get down into this gap support zone. So maybe as low as 900, but I'd be really surprised if Tesla were to go back below 900. So any weakness I'd be accumulating. Ford is another one in the auto space. I mean, Ford's been on fire. That's awesome. And I've been into some debates with other folks about Tesla versus Ford. And the one thing I'll say is, yeah, Ford is definitely benefiting from the EV. You know, the current is taking it higher, just like it's taking a lot of auto stocks higher. Let me show you a little something here about Ford that you may not realize. I'm going to go back 25 years on their monthly chart. Did you know Ford was $24 back in 1999? And I mean, Ford really, you know, went into that pandemic and then kind of got it back, but it was $12 in the last decade. When we broke into the secular bull market in 2013, Ford was close to $12. Earlier in 2021, it was 11 and change. So, I mean, yeah, Ford definitely has got some momentum going here, but I just don't. I think all the strength from Tesla is helping lift a lot of competitors. I would take Tesla right now 100 times out of 100. If you said, who's going to be the winner over the next year or two between Tesla and Ford, I'm taking Tesla every single time. And some might say, well, yeah, but Ford's only $19 stock. has nothing to do with whether it's $19 stock or $1,000 stock. It's based on whether their market value can grow and what their earnings growth is going to be. And I believe Tesla's poised for much, much more rapid growth going forward. But again, just my opinion. Let's see. I'll pull up one more. One thing that's started to pick up again has been recreational products. And one company that I was looking at, I don't want to bring up a monthly chart. One stock I was looking at in that space was Pool. So this is SCP Pool Corp. And the volumes picked up, stocks broken out, and on a relative basis, it's at a 52-week high relative to recreational products. Now, recreational products just starting to move. So I would prefer having, I don't know if I'm going to be able to find 40 different industry groups. So there are going to definitely be stocks in this portfolio that are going to be leaders, but they're just not going to be leaders, or they're not going to be in leading industry groups. Again, unless I want to put 10 semiconductor stocks in and 10 software stocks, which I don't want to do. I don't want to overly concentrate it. You're going to have to put some industry groups in here that might just be starting to show some strength like this, or you might just find stocks that are just so strong that it doesn't matter that they've been lagging, that their group's been lagging, because that stock has been shooting through the roof and has been showing tremendous relative strength. So there'll be a little mixture of that, but for the most part, what I wanted to do was show you what I look for. And so that's basically what I have, John. So hopefully not only did you get a sense of how we're going to put the portfolios together in, later this week, but also just some overall history of the stock market and how these secular bull markets play out and why it's so important to be in those aggressive sectors in order to outperform the S&P 500. All of that ties in to what we do. We just don't go out and just find, oh, this stock's looking good, it's breaking out. That's not the way we go through this process. And I think what we do is completely different than any other service that I've ever seen, because we do tie in the fundamentals with the strong earnings and the strong revenues beating Wall Street's. We tie in the history. We know historically when areas of the market do well. We know historically what areas of the market do well during secular bull markets versus secular bear markets. All of that stuff ties into our strategy with these portfolios. So if you are new to Earnings Beats, I do hope you'll at least sign up for a 30-day trial. If you're a trial member, you haven't paid a cent. It's free for 30 days, and you'll get our portfolio stocks come Thursday. Everybody, you don't have to be a paid member. You can be a trial member to be part of everything we offer to our members. There are some Excel spreadsheets and a couple of chart lists that we reserve for our annual members, simply because we put so much time and effort into them that we want to make sure that our members are committing to us and we're committing to them. But otherwise, 95% of what we provide in Earnings Beats is available to our trial members. So we'd love to have you check it out. And as John mentioned earlier, Aaron did a great job setting up the special. So just want to make sure everyone is aware. If anybody came in late, if you go to earningsbeats.com, we are running not only the best deal of this year, but this is the best deal we've ever run. And it's because we spaced it out to give folks that want to sign up for an extended period of time and commit to us longer. We're going to give you a lot of free months. So anybody who signs up today, pays us the annual amount, is going to get 2 bonus months. If you pay for 2 years, you're going to get 6 bonus months. So you'll get 4 extra bonus months for that second year. And then 3 years, you get a full year free. So you're going to get 4 years for the price of 3. And this deal right here, $62 a month, you normally would pay $147 a month. In other words, if you take a trial to Earnings Beats and you just let it flip to a monthly subscription, you're going to pay $147 a month. But if you like what you see and you really believe in what we offer, and you like the education we provide and the guidance, the research, all of that, then you might as well commit to us, and you're going to pay $62 a month instead of $147. You're going to save 58%. That's quite the saving. So that's going to last for the next couple of weeks. So you can start a subscription, take a look, make sure you're comfortable, you like what we do. And then if you do, take advantage of this fall special. And it'll, anybody who's a current member, if you do sign up for any of this, it will extend your membership. So if you still got 6 months or 9 months left and you just want to get in on this deal, by all means do it, and we will add the time to what you already have. And one last thing on the trial members, you get 30 days. So if you sign up and let's say you do a year, you're going to get your year, you're going to get 2 bonus months, and that's going to be added on to your 30-day trial. So if you're 2 weeks into your trial and you want to sign up, you're not going to lose the other 2 weeks of your trial. You're still going to get that, and then everything gets added on. But that's all I have, John. Just want to make sure everybody's aware of the fall special we have going right now. Just started it today. We'd love to have you join us.
Yeah. Okay. A couple questions. First, just one comment. Hi, Tom. Thank you. You're a great teacher. That was very nice.
Thank you.
When you say you notice signs of rough patch in 2022, what are you looking at that indicates that? What signs do you watch when to be defensive?
Well, I mean, there's a lot of different signs, and I'm going to get into this a lot more in Market Vision 2022, because I do think that we're going to be fine through the end of the year. Just historically, the second half of November tends to do well. And then when you get into the second half of December, I mean, that is a very, very, very strong period of the year through the holidays and all. The market rarely closes December lower than it was, say, the 20th of December. So those last 10 days of the year tend to be very, very bullish. So I think we're going to be fine until sometime in 2022. And for somebody who's long-term and is thinking, okay, I'm going to be retiring in 7 or 8 years or 10 years, and what should I do? I would say just stick with the market, because trying to time these pullbacks is very difficult. And if you listen to the media, they'll have you jumping out of the market all the time, and you see what happens. We rally back, and then you got to figure out where in the heck you're going to get back in. So longer term, folks, I'd be careful, because if you're not timing the market, then I wouldn't worry about it. Just stick with the market and ride the pullbacks and ride them back up when we go back higher. That's my opinion, of course. I don't know for sure. Nobody's guaranteed me that the stock market's going higher the next 10 years. I just believe it's going to, based on all of my history of, all the history of the market, all my research. I believe that the stock market's going a lot higher. Interest rates are still extremely low, and I think will stay low for a while. All of those things benefit wanting to be in the stock market. They benefit valuations. As far as 2022 and the signs, I mean, there are short-term signs to look for, and then there are long-term signs to look for. I mean, if we're going to have a patch of 3 or 4 months, and we're going to drop 20%, I think you're going to see it in terms of some of those relative ratios, which look fine right now, because if the market goes up next 2 or 3 months, Wall Street's not going to start getting out of those areas now. They're going to start thinking about it as we get further down the road and into 2022. So I think you just got to pay attention to some of the signs below the surface, because CNBC is not going to tell you, I can promise you that. But if you follow some of these ratios, I think they'll start to give us warning signs. Also, sentiment, volatility index, and the put call ratio, combining those, looking at divergences on the long-term weekly charts, all of those things can help us. And none of that really is what I'm concerned about right now. I'll talk about it a little bit more at the Market Vision event, but I just think that there are going to be some fundamental reasons why we're going to struggle next year, but talk about it later.
I think that does it. Time to wrap it up, my friend.
All right. Well, I appreciate everybody coming in. I hope everybody learned something. That's really the goal of these things. These webinars are really part of our educational service. It's great from a trading perspective, but really we're just trying to help give our members an advantage out there. We know it's hard to trade the market. It's hard emotionally. So that's why we do these events. That's why I do these shows, because it's a whole lot easier when you can maybe get a little reassurance from time to time about, whether the market truly is in trouble or not. And one final rant, you're never going to hear that in the media. I'm telling you, they're trying to, it's clickbait. And hey, if I was in the media, even sometimes when I write my articles, if I write an article, I know how many, Stock Charts tracks visitors to an article. They know if they have most popular articles and so forth, where you see a lot of the articles listed. They do that based on number of visits. So we know what's going on. If I write a bearish article, I will have 2 to 3 times the number of views on my article as if I say, hey, the market's going higher. If I say, oh my gosh, we're in trouble, 3 times the number of views I'll get on that article. So if I'm a media company and a lot of my income's coming from advertisers, what do you think is their real goal? Is it to educate you, or is it to get you to click and come to their website? So, I mean, I'm not saying anything negative. I mean, about these companies, they're doing what they can to stay in business. I mean, that's how they make their money. But, going to some of these websites and looking at headlines and trying to get education, that is not where you want to get your education. Too much. I literally, I just go over here to my golf club, and sometimes I'm just sitting down with some of the guys and gals and talking about the market. And it's amazing. Some really very, very educated folks that just don't follow the financial markets that closely. And they come in and they're telling me market can't go any higher, can't go any higher. I've been saying it for 3 years. It was the trade war. It was the pandemic. It was, it's the election, it's politics, it's this, it's that, it's the debt. Pick one, just pick a topic. Bottom line is there are trillions and trillions and trillions of dollars in our economy. And when money rotates from one asset class to another, these little stories, they're little blips on the charts. They're not long-term stories. So just be careful. Anyway, appreciate you guys coming in, and we'll look forward to doing those events coming up this week. Max Payne on Tuesday. And of course, the top 10 stock picks will be on Thursday after the close. That'll probably be later. I don't know if we set a time for that one. I think it's a little bit later in the evening, just to give me a little bit more time to prepare for it. But looking forward to it, and I hope you all make it. So have a great day, everybody. Enjoy your weekend. Happy trading.